What's up, traders? If your stop losses are looking something like this when the trade's going up, it's coming back down, and the trade goes in the direction you want, keep watching this video because in this video we're going to be covering exactly why this happens, and I'm going to explain how to prevent situations like this in the future by using what we call the average true range ATR calculator. So, the first thing we need to ask ourselves is, why do we even need to use stop losses and take profit targets? Well, the simplest way for me to explain this is actually that stop losses limit your downside. They limit your downside risk, so you only risk what you've set out and you don't risk any more than that, and you don't lose any more than that. Take profits, on the other hand, they create a clear target to profit from, scale in, or even reassess a trade. They also make sure you're earning more than your losses, because it's a concept called risk to reward, which we may cover in a future video. So now, the main problem traders have when they start using stop losses is that they always get hit. And it is inevitable. But for retail traders, it happens way too frequently because they're not taught properly. So we're going to go over exactly why traders' stops get hit the most and how we can actually prepare ourselves with the right tools and the right processes to prevent it from happening so frequently. So this is the wrong way to use stop losses and targets. I see people all the time get stopped out like this, and it's literally seen every single day, and it's taught all online, which is absolutely wrong. So what is it? They base their stops and targets on candlesticks. They may put it at the bottom of a wick, top of a candle, bottom of a candle. They might put their stops and targets based on pips. I see some people out there, they're literally fixated on, I'm only having a 10 pip stop loss. I'm only having a 30 pip stop loss. Wrong. Wrong way to go about it again. They may use even technical patterns like support and resistance levels to place their stops and targets. But again, this is the wrong approach. And you even have some devils out there, some absolutely crazy madmen out there that don't use stops at all. And that means they're literally risking everything on a single trade. The list goes on, and I literally see it all the time. What they'll end up doing is blaming brokers. They'll never put the blame on themselves. But what they're really lacking is an understanding of volatility, which is how much does this thing you're trading move up and down. So in this case, in Forex, how much does a currency pair move up and how much does it move down in a given time frame? If you don't know this answer, then of course you don't know where to put your stops and targets. And it's not your fault, because all the videos online, all the people and the educators you see are feeding you junk information on how to set your stops on this, blah, blah, blah. Set your stop on this candle. Wrong. We're going to teach you today how to set stops based on volatility, which is the professional way to do it. Remember that, volatility. So, what is the ATR and what is the average true range? Well, essentially, all it does is measure the volatility, and volatility means how much does it move up and down. Here's the math, but I'm not going to go through it with you because it can be a bit confusing as a user. Instead, I'm going to show you how to make an ATR calculator in Excel, or if you're lazy like me, you can download our ATR calculator that I'm going to show you. The link will be in the description. We are running a sale on this product, up to 90% off. Get it before the coupon code runs out, ATR99, and add that in your basket. So without further ado, if you want to make it yourself, if you want to understand it, let's get straight into the video. Why is it useful? So why is the knowing ATR and the average true range and the ATR calculator useful? Well, if we know volatility, we then know where to set stops and targets, right? If we don't know the volatility, then we don't even have an idea of where to put them. So simply put, what you could say is that when there's a higher volatility, you're going to need higher stops and higher targets. When there's a lower volatility, you're going to have lower stops and lower targets. And this can be easily done using our ATR calculator, what we're going to go through. What does it look like? This is what the ATR calculator looks like at a glance. On the left-hand side, we have the price data, which we copy and paste into. I'll show you exactly in the tutorial in a second. Everything else on the calculator is automated after that point. So it'll show you the ATR average over a given time period, which is the month. Over here, it'll calculate the average monthly ATR over the past 6 months and 12 months. So you get a grasp of the past year, how much this asset actually moves. Then the good stuff, when we move down into this green area down here and this red area, the green area is just the area which you actually start typing in the price. So in this case, we put exchange rate. So if the exchange rate was 1.1839 and the actual price data was all put in on the left hand side here, the calculator would then automatically calculate the volatility, which on average is about 3% for the whole year, the average monthly volatility. And based on that 3.3%, we can then set a soft target and a stop loss based on that percentage. Because what that percentage is saying is how much roughly on a monthly basis this exchange rate is moving. That's the exact same thing for the short calculator down here. So this calculator is super useful, and let's jump straight into it now. So here's the calculator. Here's exactly what the ATR calculator looks like. Again, this is the section that we're going to copy and paste. Very easy. Just get the last 12 months of data from investing.com, paste it in, and then everything else will automatically populate over here. Then the only thing that you need to do is type in whatever exchange rate you want to put in here. So in this case, it was 1.1839 as the example, okay, because that's the price over here. Then it'll automatically calculate your stop loss, which is 1.14, and a soft target of 1.3. So how do we actually then, apply this? How do we actually work out what it's doing? Well, the first step we're going to do, I'm going to show you exactly that. So what we want to be doing is going to Google. You want to type in investing.com, and then the currency pair you want to trade. Let's take Euro USD as an example. And then we want to type historic data on the end. Okay, go ahead and do that. Click the first link, which should be Euro USD historical data by investing.com. Okay, you want to go down here. Because I'm trading over a 12-month time horizon, so I'm trading on a weekly time chart, I'm actually going to go to the monthly time frame and then copy and paste the past 12 months, so copy that into the calculator over here, paste. Okay, now that you've done that. So now that we've done that, the calculator's automatically worked out roughly what the average volatility is over the past 12 months. And how has it done that? Well, it's done that firstly by calculating the high to low of each month, okay? And then the monthly ATR of that month. So what it does here is it basically sums up the current high to low and the previous high to low, divides that by 2 to get an average high to low over the past month, and then it divides it by the previous open because that's where it moved from previously. So that's what's given us 4% here. And then over the past 6 to 12 months, we can work out an average, and that average is then used in our calculation. So the current price is 1.1898, and you can see the exchange rate values change over here, the stop loss values change, and the soft target changes because it's changed based on the volatility value here. And you can do this with any type of time frame. For example, if you're not like me and you don't trade the weekly time frame, you might trade, let's say, daily. Okay, so if you trade the daily time frame, go ahead and copy and paste the last 12 weeks, paste that into here, exact same thing, and you'll get a smaller stop loss and target. And I'll explain to you exactly why in a second. So if I go ahead and just get the past 12 weeks, 4, 5, 6, 7, 8, 9, 10, 11, 12, if I go ahead and copy and paste that into the calculator, what's it going to give me? It's giving me this. So, sorry, I get 13 weeks of data. What has it done? Well, you can see that the average volatility, the average monthly ATR has gone down. But why is that? Well, what it's saying is the lower the time frame you go, the less the asset, the currency pair moves. And that makes complete sense as a Forex trader. Okay, does that make sense? So the lower the time frame you go, the less it's actually going to move. But the higher time frame, the more it will move over that period. Okay, and that's why you have an average monthly ATR of 1.69 instead of the previous ATR, if I Control Z it, which was 3.312. Okay, because you're trading those lower time frames. Let's go ahead and try the daily data. So go ahead and get the past 13 days of data, go ahead and paste it into here, and what do we have? We have an average ATR, a daily ATR, of 0.75%. So on average, on a daily basis, Euro USD only moves 0.75%. That's not even 1% per day. So that means that you're setting your stop losses at a much lower percentage, which you can see over here. So let's put that into an example onto the Euro USD chart. Okay, what would it look like? Well, if we go ahead and go to Euro USD trading view, and we just open up a random Euro USD chart, what will it actually look like, the values that we put into the calculator? Let's take a look. So we have an exchange rate of 1.1896 and a stop loss of 1.1806. Okay, so here's the most recent data. We have a stop loss of 1.1806. So let's just draw a line, horizontal line. We'll get that on there. This is going to be our stop loss. So if you remember, the stop loss is what? It's 1.1806, just down there. Our entry line is here, just at this candle. So let's get this in red as the stop loss, blue as the entry line, and then what is our target? Let's have a look. Our target is 1.2166. So our target is somewhere around up here. 1.2166. Okay. Let's change that to green as our target. And that is what our target looks like based on volatility. And we've used, what data did we use? We used the daily data from investing.com. So if I was to be trading, on a day-to-day basis, this is what it would look like on a volatility basis, not using candlesticks or anything like that. This is how I'd be setting my stop loss and targets. And if I was using the weekly data on here or the monthly data, these stops would be much wider as you keep going, because why? The volatility is getting much higher over a longer period of time too. And that's what's very important about trading currencies, because the volatility on different currency pairs is going to be different. It's not all going to be the same, and that's why you can't be using the exact same stop losses and targets for each thing. For example, if I go ahead and put USD NOK historical data, we're going to get a completely different outcome. So let's go ahead and put monthly, and then we want to get the past 12 months or 13 months. What is the outcome going to be like? Let's go ahead and do that. Let's wait for that to load. What is it going to look like? Let's have a look. So if we paste the last 13 months of data in, the volatility for USD NOK is 7%. That's double the volatility of Euro USD. That means our stop has to be twice as large and our targets have to be twice as large. And you'll realize that our targets are always at a 1 to 3 risk reward, because that's one of the best benchmarks of actually getting a really great risk reward return given a certain strategy. So now you know how exactly this stop loss calculator works and the take profit target calculator works. You understand how important it is to trade Forex using this, because you can't be setting stop losses based on random candlesticks, random price patterns, support and resistance for everything, because each currency pair has different volatility, and we need to assess that volatility whenever we're trading different assets. If not, you'll see again and again yourself getting stopped out, and that's just going to be a recurring theme throughout your trading. At least when you're using volatility assessments, using this type of ATR calculator, you have a chance of getting in and out of trades before they're becoming a losing one. For example, when you have a stop loss here due to the volatility, you actually know that this trade shouldn't be working. Your idea was wrong, okay? But when you're just placing stops using candles, but then it gets hit and goes in the direction you wanted, your trade idea was actually right. And that's why you need to be using this volatility assessment calculator and actually the ATR calculator itself. So if you want to go ahead and grab that, the link will be in the description. Use ATR99 as a coupon code to get up to 99% off, and we'll get straight back into the presentation on how I use it in my own trading. So how do I use it in my trading? Well, this is my 5-step process to trading. First, I'll scan over the macro currency strength meter here at Logic FX, and that's what checks currencies, whether they're weak or strong, and that way I can filter the market instantly, efficiently, on a fundamental basis, because our currency strength meter analyzes economics behind each economy, which makes it so much better than everything else out there. Next step, I'll compare one currency against another using relative analysis, and this is done manually using Excel. And if you're actually interested in learning about that, we're conducting an online web class on fundamental analysis properly, and it actually will give you that edge in the market and that outlook of, wow, fundamentals are really necessary to trade, because that's what we're trying to promote here at Logic FX. Traders need to know about how to conduct proper fundamental analysis. The link for that free web class will be in the description below. It'll be logicfx.com/learn-to-trade for anyone interested in there. Third step, I'll scan over the COT analysis tool we have at Logic FX. This will check whether the markets are with us or against us. And if they're with us, we can move on to step 4, which is price analysis. And this is just to confirm whether buyers or sellers are coming in on a certain price and they're actually agreeing with our idea on a technical level. Then the final step will be, when we're confident that all these steps line up, is to actually apply the ATR calculator, set our stop loss, set our stop target, and let that trade go. And that's basically how you should be using average true range, ATR, in your analysis. Forget all the indicators that are out there, forget the ATR indicator. This is one where you can actually use so much easier in an instant to calculate your stops and targets. Thank you so much for watching. Do make sure to subscribe, like the video, comment what you think about this one, and we'll be releasing way more content in the future. It's Matty from Logic FX.